Something extraordinary is happening in the silver market, and this time, it's not just about price movements or trading profits. We're witnessing a convergence of forces that reaches far beyond the trading floors. Industrial demand, strategic stockpiling, supply chain vulnerabilities, and national defense priorities are colliding in ways we haven't seen in decades. This isn't another commodity story. This is about critical infrastructure. This is about the materials that power our defense systems, our renewable energy transition, and the technology that underpins modern society. When silver markets experience severe disruption, the ripple effects touch everything from solar panel production to semiconductor manufacturing, from missile guidance systems to medical equipment, from electric vehicles to water purification. The question isn't whether you own silver. The question is whether you understand what market disruptions and critical materials reveal about the broader economic landscape we're navigating. Today, we're going to examine this situation with the clarity and composure it demands. No predictions, no hype. Just clear analysis of what's happening, why it matters, and how thoughtful investors should think about their positioning. Because in moments of market stress, the difference between financial success and painful losses often comes down to one thing: understanding the difference between price movements and fundamental value shifts. Are we seeing a temporary shock in a volatile commodity? Or are we witnessing the early stages of a structural supply crisis that could reshape industrial and defense strategies for years to come? Let's find out together. Silver occupies a unique position in our economic system. It straddles two worlds that most assets don't. On one side, it's a precious metal, a store of value, an inflation hedge, something humans have treasured for thousands of years. On the other side, it's an industrial commodity. 56% of annual silver demand comes from industrial applications. That's not jewelry or investment. That's manufacturing. This dual nature creates complexity that most investors miss. When you hear about a silver crisis, you need to ask, which silver are we talking about? The silver in photovoltaic cells for solar panels? The silver in electrical contacts and switches? The silver in medical devices and water purification systems? Or the silver sitting in vaults as an investment asset? The answer matters enormously. Let's talk about what makes this situation different from previous silver market volatility. Modern defense systems rely on silver in ways that have no viable substitutes at scale. Missile systems, radar, night vision equipment, electronic warfare capabilities. These aren't applications where manufacturers can simply switch to copper or aluminum. Silver's electrical conductivity exceeds every other element. Its thermal conductivity is unmatched. Its reflectivity in infrared applications makes it irreplaceable in certain military technologies. When the Department of Defense assesses critical material vulnerabilities, silver appears on lists alongside rare earth elements and strategic minerals. Now, pair that reality with another fact. Silver production is highly concentrated geographically. Mexico, China, and Peru account for roughly half of global mine production. Do you see the national security dimension emerging? This isn't just about price. It's about supply security in an era of great power competition and fragmenting global supply chains. Silver isn't mined the way gold is mined. Approximately 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. What does that mean practically? It means silver supply doesn't respond quickly to silver prices. If silver prices double, mining companies can't simply open more silver mines. They're producing silver incidentally while mining for other commodities. This creates inelastic supply response. It means supply disruptions, when they occur, can persist even when prices rise substantially. In recent years, we've seen production challenges multiply. Declining ore grades, aging mines, permitting delays for new projects, labor disputes, energy costs affecting processing. Meanwhile, demand from industrial sectors has been growing. The solar industry alone has increased its silver consumption dramatically. Each photovoltaic cell requires silver paste for electrical conductivity. As solar installations scale globally, this demand vector compounds. Electric vehicles use more silver than traditional vehicles. 5G infrastructure requires silver. The electrification of everything, from buildings to transportation, is a silver-intensive transition. Here's where the national security angle becomes concrete. Multiple governments have begun reassessing their strategic reserves of critical materials, not just in response to recent geopolitical tensions, but as a systematic reevaluation of supply chain vulnerabilities exposed during recent disruptions. When industries couldn't get semiconductors, the world paid attention. When rare earth supply chains showed vulnerability, governments took notice. Silver, despite its importance, has limited strategic reserves in most countries. The United States eliminated most of its strategic silver stockpile decades ago when industrial applications were less critical and global supply chains seemed permanently stable. That calculus is being revisited. If governments begin stockpiling silver for defense and critical infrastructure purposes, they won't be price-sensitive buyers. There'll be strategic buyers focused on supply security regardless of cost. This introduces a new category of demand into a market that was already showing signs of tightness. Now let's examine the behavioral dimension of what's happening. Silver has always attracted intense emotional reactions from investors, more than gold, more than most commodities. Why? Silver's volatility creates the possibility of rapid gains. Its lower price point feels more accessible to retail investors. Its industrial story provides fundamental narratives that feel compelling. This combination tends to attract momentum-driven behavior. When silver rallies, it can attract enormous speculative interest quickly. When it declines, that interest evaporates just as fast. We've seen this pattern repeatedly. In 1980, silver briefly touched $50 per ounce before collapsing. In 2011, it approached 50 again, then declined 70% over the following years. Each time, the narrative at the peak felt unassailable. Each time, investors who bought near the top and didn't manage their risk suffered substantial losses. The current situation has different fundamental characteristics than those previous episodes. The industrial demand story is more concrete. The supply concerns are more structural. The geopolitical dimension is more pronounced. But human psychology doesn't change. Fear and greed still drive poor decisions. Momentum still attracts late-stage participants. Volatility still triggers emotional reactions that destroy portfolio value. Understanding this history isn't about predicting the future. It's about maintaining perspective when market movements start feeling unprecedented. No market exists in isolation. Silver's movements occur within a broader economic environment that we cannot ignore. Interest rates affect the opportunity cost of holding non-yielding assets like physical silver. Currency movements influence commodity prices denominated in dollars. Inflation expectations affect precious metal demand. Manufacturing activity drives industrial consumption. Right now, we're navigating an economic environment characterized by significant uncertainty. Central banks are managing competing pressures. Growth trajectories remain unclear across major economies. Geopolitical tensions are elevated and persistent. In this context, markets for critical materials become pressure points where multiple forces converge. Industrial demand depends on manufacturing activity and capital investment in sectors like renewable energy and electronics. Investment demand depends on inflation expectations and real interest rates. Strategic demand depends on government policy and supply chain security assessments. When these forces align in the same direction, market impacts can be substantial and sustained. Let's separate signal from noise in what we're observing. Significant price volatility in commodity markets happens regularly. It doesn't always signify a fundamental shift. Sometimes it reflects positioning changes by large traders. Sometimes it reflects temporary supply or demand shocks that resolve quickly. Other times, price volatility is the market's way of discovering a new equilibrium after fundamental conditions have shifted. How do we distinguish between the two? We look at multiple indicators beyond just price: inventory levels at exchanges and warehouses, futures market positioning, premiums for physical metal over paper contracts, delivery delays and availability in physical markets. We examine whether industrial users are altering their procurement strategies, whether fabricators are reporting difficulty sourcing material, whether substitute materials are being adopted where possible. We assess whether the price movement has attracted speculative interest, or whether it's being driven by users competing for available supply. These distinctions matter enormously for investment decisions. A price move driven by speculative positioning can reverse as quickly as it emerged. A price move driven by physical market tightness tends to persist until supply conditions improve or demand destruction occurs. Current market signals suggest elements of both. There is speculative interest. There is also genuine tightness in certain physical markets and growing concern among industrial users. If you currently hold silver positions, the first question to ask yourself is simple. Why do you own it? Was it a speculative trade based on price momentum? Was it a long-term inflation hedge? Was it portfolio diversification? Was it a strategic holding based on industrial demand fundamentals? Your answer should determine your next actions. If you purchased silver as a long-term strategic holding based on fundamental analysis of supply-demand dynamics, current volatility shouldn't trigger emotional reactions. Review your original thesis. Has anything fundamentally changed? If not, volatility is simply noise. If you purchased as a shorter-term trade, you need to assess whether your risk parameters have been exceeded. Do you have defined exit levels? Have they been triggered? Are you operating with discipline or hope? Hope is not a risk management strategy. Let's talk about position sizing. If your silver holdings represent a disproportionate percentage of your portfolio, volatility creates emotional distress that clouds judgment. A position that keeps you awake at night is too large. Full stop. Proper diversification means no single position, no matter how convicted you are, should have the power to materially damage your financial security. If you find yourself checking prices obsessively, if market movements are affecting your emotional state, you're overexposed. The solution isn't to exit emotionally at potentially the wrong moment. The solution is to scale down to a position size that allows you to think clearly. Consider your holding structure: physical metal, ETFs, mining equities, futures, or options. Each has different risk characteristics and appropriate management approaches. Physical metal has no counterparty risk, but has storage considerations and liquidity limitations. ETFs provide liquidity, but introduce fund structure risks. Mining equities provide leverage, but expose you to company-specific risks beyond metal prices. Derivatives provide leverage, but have time decay and margin considerations. Match your holding structure to your time horizon and risk tolerance. For long-term holders with appropriate position sizing, volatile periods can actually be opportunities to improve positioning. When panic sellers create temporary price dislocations, patient buyers with capital can add at favorable levels. But this requires having capital available. It requires not being fully invested at any time. It requires maintaining liquidity precisely so you can act rationally when others cannot. If you're considering entering a position in silver now, after significant price movement, you need to confront your motivations honestly. Are you responding to fear of missing out? Are you extrapolating recent price action into the future? Are you acting on someone else's conviction rather than your own analysis? These are all dangerous foundations for investment decisions. The worst investment mistakes typically happen when people purchase assets after large price moves, driven by emotional momentum rather than analytical conviction. That doesn't mean the move is over. It means you're entering with significant timing risk and emotional vulnerability. If you believe the fundamental case for silver is compelling, the question isn't whether to invest. The question is how to invest in a way that manages your timing risk and emotional exposure. Consider a phased entry approach. Rather than committing your full intended allocation immediately, divide it into multiple tranches over time. This averages your entry price and reduces the risk of having your entire position entered at a local peak. This approach requires patience. It requires discipline to stick to your plan even when prices are rising and you're worried about missing it. But it also protects you from the devastating experience of committing all your capital right before a significant correction. Define your investment thesis clearly before you act. Write it down. What exactly are you betting on? Supply constraints, industrial demand growth, monetary inflation, strategic stockpiling? Be specific, because when prices become volatile, and they will, you'll need to refer back to your thesis to determine whether your original reasoning still holds. Understand your time horizon. Are you investing for 3 months, 3 years, 30 years? Silver's price path over these different time frames could be radically different. Short-term volatility that would destroy a short-term trade might be completely irrelevant to a multi-decade holding. Your time horizon should determine your acceptable volatility and your appropriate position management. Think about your total portfolio context. How does silver fit within your broader asset allocation? Are you already exposed to commodity price movements through other holdings? Do you have sufficient stable income-producing assets to weather volatility in more speculative positions? Silver should be part of a portfolio strategy, not your entire portfolio strategy. Consider whether you're better positioned to invest in physical silver, silver miners, or silver-intensive industries. These aren't the same investment. They have different risk-return profiles. Physical silver gives you direct commodity exposure. Mining companies give you leveraged exposure but introduce operational and management risks. Silver-intensive manufacturers give you exposure to the industrial demand story but are full businesses with their own dynamics. Choose based on your skills and comfort evaluating different types of assets. Let's talk about something most investment content ignores: your personal risk capacity. This isn't about risk tolerance, your willingness to take risk. This is about risk capacity, your ability to absorb losses without it affecting your life. If you're in your 70s and living on a fixed income, your risk capacity for volatile commodities is extremely limited regardless of your risk tolerance. A significant loss could materially affect your quality of life. If you're in your 30s with a stable career, growing income, decades until retirement, and no major financial obligations, your risk capacity is much higher. Understand where you are in your financial life. Invest accordingly. Risk capacity also depends on your total financial picture. Do you have adequate emergency reserves? Are you carrying high interest debt? Do you have insurance to protect against catastrophic risks? Are your essential retirement savings on track? If you haven't addressed these foundational elements, you shouldn't be making speculative commodity investments regardless of how compelling the opportunity appears. In periods of market stress and exciting price movements, financial media and social commentary become extremely noisy. Everyone has an opinion. Everyone has a prediction. Everyone claims special insight. The vast majority of this commentary is worthless or worse than worthless. Develop your own analytical framework. Understand the fundamentals of what you're investing in. Don't outsource your thinking to personalities, commentators, or self-proclaimed experts. This doesn't mean ignoring all outside information. It means filtering information through your own critical assessment. Ask yourself, does this person have a track record of accurate analysis? Do they have skin in the game, or are they selling content? Do their predictions have clear timeframes and conditions that would invalidate them? Are they providing analysis or entertainment? Most financial content is entertainment disguised as analysis. It's designed to generate engagement, not to improve your investment decisions. Seek out sources that teach you how to think, not what to think. Sources that explain their reasoning clearly and acknowledge uncertainty. Sources that discuss risk management as much as opportunity. Build your own knowledge base about the markets you invest in. Understand the supply side, understand the demand drivers, understand the historical price cycles and what drove them. This foundational knowledge allows you to maintain perspective when headlines are screaming crisis or opportunity. Let's be direct about behaviors that destroy portfolio value during volatile market periods. Taking positions that are too large relative to your portfolio because the story feels compelling or because you're afraid of missing out. This guarantees you'll make emotional decisions at precisely the wrong moments. Borrowing money or using margin to amplify your commodity exposure. Leverage magnifies both gains and losses. In volatile markets, it can force you to exit positions at the worst possible times when margin calls arrive. Leverage is a professional tool that retail investors typically use incorrectly. Unless you thoroughly understand the mechanics of leverage, the specific risks of your leveraged instruments, and have experience managing leveraged positions through volatility, you should avoid it entirely. Buying after large price increases simply because the price is moving. This is how people consistently buy tops and then panic sell bottoms. Price momentum can persist, but it can also reverse suddenly. Without fundamental understanding of what you own, you have no framework for deciding whether to hold through volatility or exit. You developed an investment thesis, a time horizon, and exit parameters before you invested, or at least you should have. When volatility arrives, abandoning that plan based on fear or greed typically results in poor outcomes. Plans exist precisely to guide you when emotions are elevated. Perhaps you're convinced silver is entering a transformational period. That conviction doesn't justify putting your entire portfolio into silver or silver-related investments. Concentration creates fragility. Diversification creates resilience. Even if your silver thesis proves correct, proper diversification ensures that other parts of your portfolio are working while silver is volatile. Commodities don't compound over time the way businesses do. They don't generate cash flows. Their long-term expected returns are lower than productive assets like equities. Commodities serve specific portfolio functions: inflation hedging, diversification, strategic exposure to supply-demand dynamics. But they're not replacements for a core portfolio of productive assets. These environments are designed to generate engagement through emotional content. They're dominated by the most vocal participants, not the most knowledgeable. They create echo chambers that reinforce existing beliefs and amplify emotional reactions. They're nearly useless for investment decisions and often actively harmful. Have different tax treatments. Short-term trading can generate significant tax liabilities that dramatically reduce your net returns. Collectibles tax rates may apply to physical precious metals in some jurisdictions. Understand the tax treatment of your holdings before you execute strategies. To assume the trend will continue indefinitely. When it's falling, it's tempting to assume it will never recover. Both assumptions are wrong. Volatile markets move in both directions. Position sizing and risk management should assume volatility will eventually move against you, even if you're ultimately correct about direction. Overlooked. Physical precious metals are valuable, portable, and difficult to trace. They require appropriate storage and insurance. Home storage introduces theft risk and may not be covered by standard insurance policies. Bank storage introduces access limitations and counterparty considerations. Professional storage introduces costs and trust requirements. These aren't reasons to avoid physical metal, but they are considerations that require planning. You're not immune to behavioral biases. Neither am I. Neither is anyone. Recognizing this fact is the first step toward managing its impact on your decisions. Confirmation bias will lead you to seek out information that supports your existing position and dismiss information that contradicts it. You'll unconsciously filter information to support what you've already decided. Recency bias will cause you to overweight recent price action in your assessment of future probabilities. If silver has been rising, you'll unconsciously expect it to keep rising. Loss aversion will make potential losses feel roughly twice as psychologically painful as equivalent gains feel pleasurable. This asymmetry causes people to hold losing positions too long and sell winning positions too early. Anchoring will cause you to fixate on specific price levels, perhaps your purchase price or a recent high, and make decisions based on getting back to that anchor rather than based on current conditions. These biases operate unconsciously. You can't eliminate them, but you can build processes that reduce their impact. Written investment plans, mechanical rebalancing rules, position sizing limits, predefined exit parameters. These structures help you make better decisions by removing some decisions from the emotional moment. We've covered substantial ground in analyzing what's happening in silver markets and its broader implications. Now let's bring this back to what matters most for your financial well-being. Market volatility, including volatility in critical materials markets, is a permanent feature of our economic system. It's not an aberration. It's not something to fear. It's simply the mechanism through which prices adjust to changing conditions. Your success as an investor doesn't depend on avoiding volatility. It depends on approaching volatility with clarity, discipline, and appropriate risk management. The investors who build lasting wealth aren't those who make perfect timing decisions. They're the ones who maintain rational positions through inevitable periods of uncertainty and volatility. They understand that markets will periodically experience stress. They position themselves to survive those periods rather than being forced to exit at the worst moments. They maintain diversification that allows one part of their portfolio to stabilize while other parts are volatile. They keep adequate liquidity to handle personal emergencies without being forced to sell investments at disadvantageous times. They understand the difference between price movements and fundamental value changes. The national security dimension of critical materials like silver is real. It's not hype. It's not a marketing narrative. Modern industrial societies depend on complex supply chains, delivering specific materials for defense, infrastructure, and essential industries. When those supply chains show vulnerability, it creates genuine strategic concerns. But understanding this reality doesn't require you to make dramatic portfolio changes or take outsized speculative positions. It means recognizing that we're in a period of supply chain reassessment across many critical materials. It means understanding that commodity markets may experience different dynamics than they did during the decades of unquestioned globalization. It means being thoughtful about exposure to resources that combine industrial criticality with supply constraints. But it doesn't mean abandoning diversification, ignoring risk management, or betting your financial security on any single market development. If there's one framework I want you to carry forward from this analysis, it's this. Separate your analysis of what's happening in the world from your portfolio implementation of that analysis. You might be completely correct that silver faces a structural supply challenge. You might be right that industrial demand will grow substantially. You might accurately identify a multi-year bullish setup. And you can still make catastrophic portfolio mistakes by implementing that view incorrectly. Position sizing, timing, risk management, and emotional discipline matter as much as analytical accuracy, perhaps more. The most brilliant market analysis combined with poor implementation leads to losses. Reasonable analysis combined with disciplined implementation leads to sustainable results. Focus as much energy on how you invest as on what you invest in. Markets will continue to evolve. New information will emerge. Conditions will change. Your job isn't to predict all of this. Your job is to position yourself to adapt and survive regardless of what emerges. Build a portfolio structure that can weather surprises, maintain liquidity, diversify thoughtfully, size positions appropriately, stick to your plans. When you hear alarming headlines about market shocks or critical shortages, pause. Separate the signal from the noise. Assess whether it changes your fundamental understanding or whether it's simply volatility around an ongoing trend. Ask yourself whether you're reacting emotionally or responding strategically. The difference between these two modes often determines your financial outcomes. The situation in silver markets is significant. It deserves attention and thoughtful analysis, but it's one development in a constantly evolving economic landscape. It's not the only thing happening. It's not the only thing that matters for your portfolio. Maintain perspective, stay disciplined, focus on what you can control, your risk management, your behavior, your positioning, rather than on what you cannot control. The investors who thrive through volatile periods aren't those with perfect foresight. They're those with strong processes, appropriate risk management, and the emotional discipline to stick to their plans when it's difficult. You have the information you need to make thoughtful decisions about your exposure to these markets. You understand the fundamental drivers, the risks, the opportunities, and the pitfalls. Now it's about implementation. Take time to review your current positioning. Assess whether it aligns with your actual risk capacity and time horizon. Make any necessary adjustments thoughtfully, not emotionally. Then turn your attention to the other aspects of your financial life that require focus. Your career development, your skills enhancement, your relationship with money and spending, your estate planning, your insurance coverage. Successful financial lives are built on multiple foundations, not on timing one market correctly. The markets will do what they do. Your job is to position yourself to benefit from opportunities while surviving the inevitable periods of stress and uncertainty. That's not exciting, it's not dramatic, but it's what works. Stay rational, stay disciplined, stay focused on the long term. That's where real financial security is built. Thank you for your attention to this important analysis. Think carefully, act deliberately, and always prioritize your long-term financial well-being over short-term market excitement.